My guest today is Kriti Watson, who is the MD and CEO of TCS. Kriti, thank you very much for joining us on NDTV Profit. My first question to you is, you spoke about growth. Your growth also spoke about, it's difficult to call out at this point in time. I want you to elaborate this statement because you grew in Q1, and you are saying that you will do better than FY24. So how do you, elaborate on the growth and what exactly, when you say that it's difficult to call out?
Sajit, it's quite simple. Like we keep tracking the kind of projects that we do, the kind of customer confidence in what they want to do, and what kind of projects get reprioritized. We still find some amount of volatility there, and we also seen instances where some of the projects have been paused at a shorter notice. So when that tendency reduces, right? When projects don't get paused at a shorter notice, or when reevaluation of long-standing project comes down, it will give us more confidence. But currently, customers continue to be evaluating projects, looking at which is the right place to invest. So as long as that investment with a stricter scrutiny continues at the same level, we have to be cautious.
And do you think that this would be there for another 2 to 3 quarters more?
I don't want to put out, say, in medium term it will continue to be there, like maybe the US elections, maybe even the Fed reduces the interest rates. Those could be the triggers for them to gain greater confidence.
The street is penciling in around 7% growth in terms of dollar terms for you for FY25. What is interesting is that India plays a big role in that growth because they're penciling around 2% growth coming in from India alone. 1%, I think, one of the top clients like Aviva, and 4.5% coming from the core businesses which are running now. How important is the India business, and do you expect to complete the India business in FY25, especially the BSNL order?
The BSNL order, we had suggested, as I mentioned, that it will be a 24 months program, and we believe we are on track to complete as per that 24 months deadline we had agreed with the government. But otherwise, we see India as a very important growth market for us, with India itself growing 7-8% GDP every year. And technology is still while the top enterprises use technology in a very significant way, but there is under-penetration if you go down the ladder. And so to that extent, we believe there's greater opportunity in India, and maybe you can have different kind of models. A SaaS model could be more applicable in India, where we can greater opportunity exist.
Every brokerage note is talking about India-led growth in Q1, and they are also talking about India-led growth in FY25. Is there an impetus in TCS now to push more India business so that it becomes a counter-cyclical to global headwinds?
Sajid, what we are doing is largely not only India, all our emerging markets of India, Asia Pacific, Middle East, Africa. We are looking at all of them together as a third pillar. So if we take US, North America as one pillar, UK, Europe as second, we are looking at this as a third pillar, where it is not very significant now, but we believe it can become a significant part of our growth. And these are the markets where anyway more investment is happening, more the growth prospects are much better. So we are very focused on these markets today. India is an important part of that.
And how comfortable are you about the statement that you made that you'll grow more than FY24 in FY25? And is the street penciling in right when they say that your growth could be upwards of 7% in dollar terms in revenue?
I'm not going to say 7%, 8% kind of. I'm not getting into that because we have not been giving any guidance. But we are confident, like we did. Our confidence comes from two factors, like what is the exit rate we had coming out of FY24, and what is the entry into this year. So those give us the confidence that we'll have a much better year than FY24.
Do you still stick to that 26 to 28% EBIT margin for the medium term?
We always mention like that's a guiding beacon. We want to be there between 26 to 28. And we believe there is sufficient headroom and levers for us to be there and get there. See, we did get there in Q4, and we implemented our annual wage hike. We took the hit up front. So we will continue to look at other levers to get back to that 26 to 28.
But since subcontracting cost has been bottoming out, so what kind of levers do you expect going ahead for FY25?
See, subcontracting is only one part of it. Then there are traditional operational levers in terms of improving your offshore leverage. And but more important thing is you also have to look at pricing. Like pricing has been at this level for a long time. Though we will not be able to substantially increase the pricing, but we need to look at pricing can also be improved through your better utilization of resources. You can also better product mix, right? A better product mix also can give you a better realization. So we have to look at it from both aspects. We cannot handle it only from cutting costs, right? We have to balance with the top line and the bottom line.
North America and BFSI. North America, nearly half of your revenues come from the BFSI is the biggest vertical for you. We saw some bit of sluggish growth coming in, but still a large part of your TCV came from BFSI and North America there. How do you look at it from 2 to 3 quarters point of view? Are you getting the kind of traction? Are you seeing the demand and spends coming in through those markets?
Sajit, if you like we were explaining yesterday, from on a sequential growth basis, North America BFSI did better than what it did before. So to that extent, we are at least reasonably confident that that kind of growth can continue. It's a question of how much we are able to accelerate that growth. And even if you look at our TCV is, I don't think as a proportion of TCV changed, and also you don't look into the TCV on a quarterly basis because there is a inherent lumpiness, like which deal gets closed at what time. So that you have to look at over a period of 4 quarters to see whether there's any significant change. But we are confident about our BFSI.
And what kind of demand coming from the BFSI space? Means, is there a transformation deals which are there, or discretionary which used to come and have come down a bit? Short-term deals are there.
We discussed, I think last time also I spoke to you. It's a question of the composition of the deals. It hasn't changed much. If at all there is one shift I see, there is a increased interest in technology modernization, application modernization is one area we see, because many of the, particularly if you take the BFSI sector, they have a very legacy technology built over many years. So there is an interest in modernizing the technology using cloud or using any other opportunity. But other than that, if you split between cost optimization and transformation, that has not, that proportion has not changed much.
Setting aside the verticals or the geographies, Kirti, if you look at the revenue profile in the last 4 to 6 quarters, have you seen a shift happening in the revenue profile of the kind of deals which are coming in?
See, last 6 quarters, if you say, like, it's slightly more tilted towards cost optimization compared to transformation. 2 reasons. Cost optimization deals also tend to be larger. Because customers want to see the benefit coming in quickly, so they tend to be larger and they tend to be tenured. So it was also, so slowly it shifts the proportion of revenue coming in from cost optimization. It has increased slightly, but other than that, I won't say a significant change in the type of deals we do.
One of the key things which you also spoke about, and you very categorically laid it out, saying, TCV cannot be the lead for gauging how the demand is or how the revenue is going to be.
Don't look at one quarter TCV. Look at the TCV over a period of time.
So, okay, so let's, in FY24, you had a TCV of $47.7 billion. You ended with a revenue of $29 billion, which gives you a big book-to-bill ratio of roughly around 1.47. In the first quarter, we are talking about 1.1, what is the book-to-bill ratio there. But I'm not taking the quarter one. Let's look at the street expectation of 7% growth, which you're coming into at $31 billion, and you're looking at $7 to $9 billion of average TCV. That's your guidance, which is per quarter. You're looking at 36 and 31, which is again 1.1. Is that the normalized level of bill to book?
1.1 to 1.2 would be, see, if you look at 1.2 over a period of time, it can give you a double-digit growth. Like even accounting for some of the previous TCV, like where the project gets paused earlier, so it can give you 1.1 to 1.2 will give you a double-digit growth. So that's what we are also tracking and trying to be at.
So that would be a lever that Street should look at. That it's if you're hitting 1.2, you can look at double-digit growth.
But that's a good entry point. But also like what we do, sometimes the project get paused. Like you have booked the revenue, but the project get paused, or there are ramp down. So there is always something that goes out to the bottom. So we have to be careful.
Has the ramp downs come down a bit compared to last 4 quarters?
No, I won't say that that uncertainty is continuing to be there. But what helped in this quarter is we also had ramp ups coming up. So, but otherwise, that's the reason I'm saying the overall sentiment hasn't changed significantly.
So are you seeing deal cancellations as well? Because we have been talking about deal pauses, deal cancellations since a couple of quarters now.
Very few. We have not seen any major deal cancellations. And also, like we said before, we also reviewed all the deals that we won in the last 1 year. And we looked at, are we able to convert that into revenue in a reasonable fashion. We are quite comfortable with the conversion of the recently won deals. So, like we keep repeating ourselves, it's more the deals that we signed a couple of years ago that come up for re-evaluation. It's not the ones that we signed recently. Most of the deals that we signed recently, they are converting to revenue quite nicely.
So the picture is better than what was there last quarter, because last quarter conversion of deal wins into revenue was a little bit of problem over there.
No, even last quarter, I don't know whether we gave that message. From our understanding, whatever in the recent past, that's what we've been consistently saying. The recent past, the deals that we won, there is no issue because the clients have used the same yardstick that they are using to re-evaluate the projects. So once they pass the gate, they are able to stick to that investment commitment. It's the whole projects that were signed few years ago that come up for re-evaluation. That's what we've been saying.
Okay, so last point on client budgets, they have been tight on the budgets and tight on spending on the IT. So, and I've also heard the US elections has been awaited by the client. So what is the client budget outlook looking like?
From a high level, we find the budget to be flattish. But at the same time, Rucha, like my view is that we stopped reading too much into the budget, annual budget, because they are also recalibrating on a quarterly basis. They see the demand environment, they see the market environment, they recalibrate very quickly. And second thing is, even if the budget is same, it's I think our job to find out where we can play and where we can increase our share of wallet. So we continue to go back to our clients with opportunities, but the overall budget can remain the same.
This is the talk of the town is generative AI. You have been working on a lot on that. We've seen companies now getting valuation of 5 billion, 6 billion because of generative AI. Where are you placed in that entire play, and what kind of work are you doing there?
I would say we are playing on the front foot there. We are training almost all our associates to be generative AI ready. We created what we call an experience zone, where people can get in-depth expertise in these technologies. Then we announced Wisdom Next. Wisdom Next is a platform that helps our customers in adopting generative AI faster. Then we are also doing a couple of initiatives internally, like where you can do greenfield projects efficiently using generative AI. Then our industry groups are working with our customers in identifying use cases in the entire value chain, where generative AI can bring in better products and services, so that there is otherwise if you look at only from a software engineering perspective, it's productivity gain. But you need to also see on the business outcome where you can increase the revenue and value for the customer satisfaction. We are working on those use cases as well. So we are quite deeply engaged with our customers. As we mentioned yesterday, we are close to having about 1.5 billion in terms of pipeline and about 270 programs that we are doing today.
When you say 1.5 billion in pipeline, what exactly it means? That you have already pitched for it and it's not been signed yet?
It's not signed. These are all discussions going on. I don't want to put a percentage on how much will convert into TCV, but you look at the previous quarter, it was 900 million, now it's 1.5 billion. So as a proportion, the discussion volume is increasing.
How, if I may to ask you on the TCV, what percentage would have been AI?
We are not giving that number out, Sajid, yet. Like once there is a greater stability, we'll do that.
And what kind of deal sizes are coming in from AI?
These tend to be 100,000. I would say sub-million deals. Like you don't see too many.
So
but I did talk about yesterday of one particular deal which was fairly large.
Office AI you spoke about.
Yeah, artificial AI office for somebody. But those deals also happen, but many of them tend to be in the smaller range, not very big.
If my sense is right, it's bundling of AI along with your transformation deals that's much more lucrative at this point in time rather than standalone
more
AI.
More than lucrative, I think that's going to be practical. Every customer, when they are going to be doing a large transformation or even a cost optimization program, will want to see whether we are bringing in AI as fundamental part of our solution.
You've done an AI study as well. Yeah. How big could be AI potential for revenues for Indian IT companies and like you?
It would be because like if you start looking at only from a productivity perspective, people will start looking at it as is it going to cannibalize our revenue. But if you start looking at what AI can do for the business, if you can look at how can our customers' product and services can be improved or new product and services could be introduced. In the previous, I think what I spoke to you, like our broad framework is about assist, augment and transform. While assist could be more productivity gain, but augment and transformation could be net increase in revenue for our customers, thereby it could be a net increase in revenue for us.
So when you talk about deal deferrals, does that include even generative AI deals, or is that largely about cost optimization and vendor consolidation as well?
I said deal pausing, if you're talking about, that is what we signed up about a couple of years ago. So a couple of years ago, we were not talking about generative AI. So the deals that we sign now, we are not seeing any pause there. So it's essentially the ones that we signed few years ago where customers have enjoyed the immediate low-hanging fruit and the decrease, where there is a decreasing return on investment. Those are the deals that are getting paused.
On the hiring part, you hired more than 5,000 on a net basis, but on a year-to-year basis, your count is lower. You had 6.15 lakhs in Q1 of last year, and it's 6.06. You're looking at gross additions of 40,000 trainees, which is there. What is the outlook for you for the lateral hirings and the job market, which was tighter maybe 4-6 quarters back? It eased out, so it's reflecting in your attrition numbers as well at 12.1%. But do you see that this market has eased further and you get the skill set that's required?
We do get, but same time there is also a tightness for specific very niche skill set. Like we also go to market for very niche skills. You don't go to a market every time for a generic skill. We do find for a niche skill job market is still tight, but how much we go, we have a very strong internal training engine. We try to give the first opportunity to our associates to gain new capability, to be deployable in those new technologies. If you are not able to find someone, we go to the market to hire. So we have cranked up our training engine proactively in finding out which are the technologies where there is demand going to be in the coming quarters. But as I said, if it's a very niche capability, the market is tight.
How is the bench looking for you as of today? Has it narrowed a bit compared to a few quarters?
Our utilization has improved slightly this quarter. To that extent, the bench has reduced.
And that would be the lever for you. One of the levers for you too.
It won't be we are already at our utilization is quite high. I don't know the exact number. I think it's in the 88-89%. So you don't take it beyond 90 because that utilization, that remaining 10% is not all bench. Like there are people working on other non-billable internal programs and other things. So you cannot assume all 10% is available to you. So
Kriti, we could speak another hour on this, but we are running out of time, and you also have a busy day ahead. Thank you very much for joining us on NDTV Profit.
Thanks, Ajit. Thank you.
Thank you.